Okay, so in this video we talked about in the last video we talked about investing activities. Now let's hit on the last section of your cash flow statement, your financing activities. Financing activities. What is your financing activities? This is basically the cash between basically the cash between, I'm pretty sure the formal definition is the cash between the company, right? The company and its funders. Right? So we would start off here by doing something. We start off our operating activities with our net income. We start off our investing activities with our CapEx. We're going to start off our financing with something known as proceeds from issuing debt. So let's start off by adding that, right? Your proceeds from issuing debt. So basically, when you're talking about your proceeds from issuing debt, this is basically say you take out new loans, so the borrowed money comes in as cash. So even though your company is taking on some debt, you're still getting cash from, like, say, another bank or something, because that is a cash inflow to your business, even though on your balance sheet it's going to be recorded as a liability. Whether it's a short-term debt or a long-term debt, it's going to be a loan that's taken out. So let's talk about that, right? So you have your proceeds of issuing debt. That's number one. Let's just say that's $60. We took out no new loan, so the borrowed money comes in as cash. That's basically what it is. Next, you subtract out your repayments of debt, because at the end of the day, all this stuff is just financing activities. So you're talking about debt, how much you're paying back, how much you're receiving, stuff that's talking about some stocks that you're issuing, dividends that you're paying. All that stuff is coming in the financing section. If you're repaying debt, just simply in the name, we paid, like, for example, our company pays something down on the loan principal, so cash goes out of the company and the interest was already on the income statement, so you're basically losing cash here. So you're subtracting out 30. Here we come one step down and this becomes plus or minus. You can either add your net revolver borrowings, or subtract your net revolver borrowings. Net revolver borrowings. Right? This is basically a flexible credit line that the company takes out. So we basically draw it like a flexible credit line more than we paid back, so a little cash comes in. So say that cash does come in through the revolver borrowings, you get $5, right? So then you can add back proceeds from issuing stock. So basically, say you sold new shares to investors, the money they paid comes in back to the company as cash. So let's just say we add back $12. Next, we subtract something known as our share repurchases. And specifically, these are called repurchases. And specifically, these are called buybacks, right? Your buybacks. And let's just say you're subtracting out 35 again. This is basically cash that's cash that's spent buying our own shares back, which returns to the money as shareholders, right? Which returns money to the shareholders, not as shareholders, to the shareholders. So you're subtracting out 35 because it's a cash outflow. And then here we can subtract out our dividends paid, right? Our dividends paid. And what this is, dividends, is cash we hand straight to the shareholders. It's not an expense, but this is basically for their stocks, you pay them back dividends. So it's a cash outflow and it's going out of your company, because every time a stock is purchased, there might be a dividend agreement. You get a certain dividend based on the amount of shares that you hold in a company, right? You have your dividends paid. Then you subtract out your... Oops, the Apple Pencil is not working, actually. Let me connect this back. Just one moment, please. Hopefully it hasn't died on me. That would be pretty bad. Okay, it's all good. I think it just disconnected for some time. But, okay. Speaking of which, where did I leave off? So your dividends paid, right? We talked about your dividends paid, the cash going out to your shareholders. Lastly, we're going to have a subtraction of our financing costs, right? Our financing costs, and say this is just like $2. Basically, this is the fees we paid to arrange the borrowing above. Any fees that had to do with kind of taking on debt, paying back debt, issuing stock, any like payment, anything that was any fees that were paid in regards to doing so. So if we bring this all down, this comes into your cash from financing. Why did the font change? This is kind of weird. Oh shoot, I think like the pencil is like messed up. Let me try connecting it again. Okay, sorry about that. I'll probably cut this out of the video. But if I don't, it's just like a couple of seconds. It's not that big of a deal. But cash from financing activities, right? Cash from your financing activities. That's basically what you get after subtracting and adding all these different line items. And this is going to come out to, if I'm doing the math right, 60 minus 30 plus 5 plus 12 minus 35 minus 20 minus 2 is going to become negative 10, right? It's going to be negative 10. What this is say a company's raising money, right? Then the cash from financing activity is going to be positive because there's going to be a lot of cash inflow. If there's negative, right, like in this situation, that means there's a lot of activities that have to do with kind of returning it back to lenders or paying back the debt to the owners, right? And let's just say with all of this, what we do is we kind of add everything together. So we start off with